So everybody's talking about interest rates and how it affects the economy and how it affects the stock market. One thing that interest rates are doing is they're gradually rising. And so if you're thinking about making a large home purchase or automobile, maybe you might want to consider go ahead and do it before they raise interest rates. But raising interest rates is not a bad thing. Raising interest rates slowly, like the Fed's trying to do, actually slows down the economy from preventing it from overheating. Which is always a good thing, because if the economy gets too hot and it overstimulates or it has too much supply, then whenever the economy falls, you have a bigger correction. So right now, we think the Fed is going to increase interest rates in December of this year, 2018. We think they're going to raise the interest rates probably 2 to 4 times next year in 2019. That's going to put the interest rate at around 3.5%. We think that at 3.5% is a good point where the economy could handle that type of interest rate and still grow. So we think that that's a good thing. Anything you get over around 4.25 to when you get closer to 5, that's going to have a real slowdown on the economy. So we think the Federal Reserve is going to start easing back on interest rates once that happens. So we continue to see the market going to improve. The stock market, the financial market is going to start to improve. Throughout the rest of this year and throughout 2019, it may be a slow growth and not a quick growth like we've seen in the couple of years past. But we think that overall the economy is going to improve. And at the end of the day, that's what earnings for companies matter. They want to see a bottom line growth of earnings, and that's what drives stock prices. So we think we're going to have a little bit of a growth in 2019, and it gets only to when you get to 2020 that we start seeing a real slowdown in the economy.